welcome to 10 Minutes About from Global Risk Management. Today we're going to talk about the oil market. Therefore, I've invited Arne into the studio with me. Welcome.
Thank you.
And last time we talked about the oil market was in the spring, and here you mentioned that the oil market balance would tighten here in the second part of 2023. Have we seen this tightening?
I think we can conclude that we are actually seeing this tightening now. I think also that is what has been driving crude oil prices from the low 80s to now in the mid 80s. And what is a market tightening? It is basically that today there's less oil being produced than consumed. So we are drawing on the inventories at the moment. We have this International Energy report out last week, and they actually say that at the moment we're probably producing something like 2 million barrels a day less than consumption. And remember, the whole market is above 100 million barrels a day. So it's actually quite a lot. And consumption is very, very strong. It probably peaked around 103 million barrels here in August, all-time high for consumption.
Yeah. When is OPEC satisfied? How high will they try to push the oil prices?
There's no doubt that when OPEC started to cut production in April, the Saudis said that they're going to do an extra cut. The Russians have said they will do an extra cut. Over the summer and in June into July, there was a lot of concern, but people say, okay, they're not going to do it anyway. They're just talking about it. But when we look at the numbers now, it is quite obvious that especially the Saudis are serious about pushing prices out. They have actually cut back on production. It's one of the lowest Saudi production in many years. So they are doing what they're saying. They are really trying to push prices higher, and they're actually sort of threatening the market, saying that we can do more cuts and we can extend them for a longer period of time. When are they satisfied? That's a very good question, because could they push oil to 120, 150? I don't think so, because in that situation, they would trigger a global recession, and they would probably also trigger sort of production outside OPEC. I think they are sort of targeting for a level between maybe $90 to $100 a barrel. So they still feel they have some work to do. So I think they will keep this tight market for an extended period of time. But I don't think they will push it any significantly above $100. That would be too dangerous for them.
We hear from many of our shipping clients that especially the 3.5 has become much more expensive. What's going on here?
Yeah, that's really an interesting thing, because normally we just look at the crude oil, but actually what our clients or what a consumer is using is the products. And here we're talking about residual oil, the 3.5%, heavy fuel oil, and that is very expensive at the moment. Actually, we had last week that 3.5% batch in Rotterdam was as expensive as a barrel of Brent crude. That is quite extraordinary, because this is a residual oil. There's something left when we've done all the normal production of gasoline, diesel, jet fuel, and so on. And you ask, what is going on here? There is basically a lack of heavy sour oil in the market. And where does that come from? It comes from that what Saudi is cutting off the market, that is heavy sour crude oil. And heavy sour crude oil has a high content of residual oil. Russia, it's the same type of oil. We're missing the Russian oil, especially in Europe, due to the sanctions. So on the supply side, that's definitely an issue. What is sort of replacing that oil? It draws on the inventories, but it's also U.S. oil. We're seeing a lot of export of light crude from the U.S., which has a very low level of residual oil. And then there's also something on the demand side. And during the summer, they use a lot of that residual oil in the Middle East for power production, and power production is high due to the need of cooling. On the demand side, we have seen that bitumen demand is peaking during the summer, and bitumen is basically sort of the same as heavy fuel oil they use for asphalt, right? So there's both a demand and a supply issue here, and that has really made this this area of the oil world very expensive. I think it's peaking right now, but I think we should expect that this 3.5% will be relatively expensive for the rest of the year.
So you expect it to continue?
Yeah, there's of course also on that. If we look back to 2020, when the IMO introduced this ban on using 3.5% without a scrubber, it was very cheap. But a lot of ships have now been fitted with scrubbers, so they of course have been using the 3.5, taking away the sulfur, so they don't pollute. But it means that there are demand on the side. I think it will stay expensive, but not as expensive as it is today.
And to change the topic a bit, what about China? We've noticed these weak numbers coming out. We've seen that import and exports are down more than 10% in July, falling consumer prices. Has this reopening story run its course?
Yeah, I think there is something about it. If we go back also when we talked in the spring, I was actually, and a lot of people were quite positive on Chinese demand. And it is that there's a big demand from China still, but this reopening story after they had a very significant lockdown last year is probably weaker than we thought, and there is obviously some weakness in the Chinese economy that we have a hard time to understand. But no doubt, if we look at some of the things that speaks again, prices moving higher or actually points to lower prices, that is definitely what's going on in China. Consumption, as you said, is weak, and you say import is weak. Remember, if we don't import so much from China in the West, they will also have to produce less. We saw today that the Chinese central bank cut rates, and that is of course to support the economy. Let's see if they sort of manage to get the Chinese economy back on track. I'm not sure. I think that China is something that speaks in favor of lower oil prices, and it could also be the case if we look into 2024. But for now, I think it's the supply side dominating the oil market, because OPEC is taking all this oil off the market, and then jet fuel demand, for example, has been exceptionally strong here over the summer, and we all know it because we all want to go on holiday after the years of the lockdown.
To get back to the question about China, how concerned are you about it?
I'm actually quite concerned, and also because they have been sort of reluctant. Normally, you would expect it if China see the slowdown, they will try to kickstart the economy, ease what you call fiscal policy, and so on. They've been reluctant to do that. We're seeing definitely some issues in the housing market in China. They did cut rates today. It doesn't mean that China will sort of be in a recession, but I think growth will probably be lower than we thought just a few months ago. So I'm concerned, but it's also a good thing, so to speak, because it means that it caps the upside for oil prices, given that OPEC has been this aggressive in pushing prices up. So it counterbalance what OPEC is doing to a certain degree.
So if we do see China come into the still stand, where do you think we see the impact on the product side?
I think on the product side, we have quite expensive diesel, gas oil, jet fuel at the moment, and these cracks or spreads, they're quite sort of sensitive to sort of the global business cycle. They're sensitive how much can China export of their production, because they refine it and export it. And if they don't need that much themselves, they're able to export more products to the world market. So I think it takes the pressure away from the product market to a certain degree. So these very high crack spreads where diesel, jet fuel so have been very expensive relative to crude oil, maybe we're also starting to see a peak there.
And the final question for today, will we trade above $100 US?
That was not a fair question. But no, yeah, I think that's a fair chance that we could sort of spike above that during the autumn going into the winter, but I don't think we'll be there on a sort of sustained basis. There are more like 85 to 100 range that I see for the rest of this year.
That's all for today. Thank you very much for watching, and thank you for joining me today.
Thank you for seeing me.